Welcome to The Explainer. Today we are digging into some pretty big news from Yes Bank. They've just released results that are definitely turning heads.
So, what's the big headline? A massive 55.4% jump in year-over-year net profit for its third quarter. Yeah, you heard that right. That's a huge signal that something's changing.
Okay, so a number like that is obviously impressive. But the real question is, how did they do it? What's the story behind that number? And is this a one-time thing, or are we looking at a real, sustainable turnaround? Let's dig in. All right, first things first. Let's really get into that headline profit number, because it's not just about how big it is, it's about what it signals, and it looks like a major shift in the bank's performance. So, that big year-over-year jump, that's really only half the picture. Get this, the bank's net profit also shot up by an incredible 45% just from the previous quarter. That tells you this isn't just gradual improvement. The acceleration is happening right now.
So, how exactly did they pull this off? I mean, profit like this doesn't just materialize out of nowhere, right? Well, it really boils down to two key things they did exceptionally well. They grew their income, and at the same time, they kept a super tight grip on their costs.
In this table, well, it shows you that momentum perfectly. Just look at the net interest income. That's their core earnings from lending, right? It's up nicely. But the real story is that bottom line, net profit. See how it's just climbing from last year to last quarter to right now? It's a great visual.
And this right here is the key. It's what people in finance call a positive Jaws effect. Think of it like a graph where the top line, income, is opening up away from the bottom line, costs. Income grew at nearly 10%, while their core expenses barely budged, growing at just 2%. When your revenue is growing almost 5 times faster than your costs, well, that extra cash goes straight to the bottom line. That is the engine that powered this whole thing.
Okay, a great profit number for one quarter is fantastic, but it doesn't tell you the whole story, not by a long shot. With any bank, the real measure of its long-term health is written all over its balance sheet. And that story starts with the quality of its loans.
So, let's talk about asset quality. It sounds technical, but it's actually pretty simple. It's just a way of asking, how healthy are the bank's loans? Are people and businesses actually paying back the money they borrowed?
And what we see here is, well, it's a fantastic trend. This is the slippage ratio. Basically, it's the rate of new loans going bad. And look at it. It's been steadily falling. It's now at an 8-quarter low. To put it simply, fewer new problems are popping up.
And at the same time, look at this. The bank is getting much better prepared for any problems that do come up. This is the provision coverage ratio. Think of it as their rainy day fund for bad loans. They've beefed it up to over 83%. So you have two things happening at once: fewer new problems and a much bigger safety net for the old ones.
So what happens when you combine those two trends? You get a much healthier loan book overall. The bank's main bad loan ratio, what they call the GNPA, has ticked down again to 1.5%. It's continuing that slow but steady march in the right direction.
And there's one more piece to this puzzle of core health. The bank also got stronger where it counts, its foundation of low-cost funds. Their CASA ratio, that's just the share of their deposits that come from current and savings accounts, it ticked up to 34%. Why does this matter? Because that's cheap money for the bank, and it's absolutely crucial for protecting their profit margins.
Okay, so the numbers are definitely telling a good story. But what is the bank's own leadership saying? Let's check out how they're framing these results and what kind of outlook they're giving.
Well, the CEO, Prashant Kumar, he didn't pull any punches. He straight up called it a breakthrough quarter. And he was quick to point out that this isn't just one lucky break. He used the phrase confluence of factors, which is a fancy way of saying everything came together at once: better profits, healthier loans, and real business momentum.
All right, so let's zoom out. We've looked at the profits, the costs, the loans. When you put it all together, what's the big picture takeaway here? What is the real story these numbers are screaming at us?
I think the picture is pretty clear, right? It's a story of profitability that's absolutely surging. And it's happening because they're being smart with their costs. And at the exact same time, they're fundamentally fixing the health of their loans and building a stronger foundation of deposits. This isn't just one thing. It really is a recovery happening on multiple fronts. And all of that hard work, it all comes together in this one key number: return on assets, or ROA. It hit 0.9%. Now, this is a really important metric. It tells you how efficiently the bank is using everything it has to actually make a profit. And it jumped in a big way from just 0.6% last quarter. That's a huge sign that things are really starting to click operationally.
So, the numbers are clear. There's real progress here.
And the momentum is picking up steam, which of course brings us to the big forward-looking question. Can they keep this up? And maybe, just maybe, can they hit their big, ambitious goal of a 1% return on assets even sooner than they planned? You can bet that's the #1 question everyone in the market will be watching from here on out.